You walked into the grocery store like you always do. Same cart, same routine, same handful of items. But when you get to the checkout, the total on the screen is bigger than your gut said it would be. Did I really buy that much? You look down at the receipt. You didn't buy more than usual. The items are just, well, slightly more expensive. Each one individually by a barely noticeable amount, but added up by an amount you can't ignore. Your morning coffee, a pack of eggs, the burrito at the place down the street, a loaf of bread. These are not last year's prices anymore. And it's not that you saw a single price tag change. You probably didn't. One day you just looked up and realized, somehow, quietly, everything had crept up. This is the most ordinary face of inflation. But why do prices rise? How is it actually measured? And what does it do to your life? Today, in one episode, we're going to walk through all of it. What is inflation? Let's start with the simplest possible definition. Inflation is a sustained rise in the general price level. Two key words in that sentence, sustained and general. Why does the word sustained matter? Because a single item going up in price doesn't count as inflation. If the price of beef doubled last week because of a supply shock, that's not inflation. That's a problem in one specific market. Inflation refers to the entire price level of the economy, going up not in one spike, but in a continued drifting motion. And the general price level, that's not a real number you can find anywhere in nature. It's a constructed number, a weighted average of every price in the economy. Coffee, rent, gas, haircuts, movie tickets, car repairs, takeout meals. Tens of thousands of prices averaged into a single index. That index is called the Consumer Price Index, the CPI. We'll get to it later in this episode. So the question naturally arises, why does this constructed index keep going up? Two roads to rising prices. When economists explain where inflation comes from, the first distinction they draw is this. There are two different roads that lead to rising prices. Demand pull inflation and cost push inflation. Demand pull inflation is the simpler of the two. It happens when people want to buy more than what's actually available on the market. Demand outruns supply, so prices rise. Think back to 2021 and 2022. The economy reopened after COVID. Everyone who'd been stuck at home for a year and a half started spending again, all at once. Restaurants, travel, cars, luxury goods, everything. Demand exploded. But supply couldn't keep up. Factories were still snarled. Shipping was a mess. Workers hadn't come back to the labor force. The result? Prices went up, naturally, mechanically. Demand pulled inflation up. That's the simple picture. Now, cost push inflation. This one comes from the other direction. Instead of demand pulling prices up, production costs are pushing them up. Same period, 2022. Russia invaded Ukraine. Oil and natural gas prices exploded almost overnight. Here's what happens when energy costs spike. Every business that uses energy to make something, which is basically every business in the modern economy, sees its production costs go up. And those costs eventually get passed on to consumers in the form of higher prices. Cost pushed inflation up. That's the second picture. Now, here's where it gets interesting. These two forces can run at the same time, simultaneously, which is exactly what happened in 2021 and 2022. Demand was exploding on one side. Supply chains and energy costs were getting hammered on the other side. The economy was hit with both pincers at once. That's why inflation climbed as fast as it did, peaking at over 9% in the U.S. in mid-2022, the highest reading in 40 years. And it's why the Federal Reserve's response was so aggressive. The fastest rate hiking cycle since the Volcker era. The money supply mechanism. Underneath the demand and supply story is a deeper variable, one step further down. The money supply. The intuition is simple. When there's more money sloshing around in the economy, each individual unit of money, each dollar, becomes worth relatively less. Imagine a small village. If one person owns gold, that gold is worth a lot. If every single person in the village suddenly has a bag of gold each, the value of any one bag drops dramatically. Money works the same way. When money gets common, you have to hand over more of it to buy the same things, which is just another way of saying prices go up. This is the most fundamental mechanism by which inflation actually happens. So who controls how much money is in the system? The first line of answer, central banks. The Federal Reserve in the U.S., the European Central Bank, the Bank of England, the Bank of Japan. Central banks expand or contract the money supply by adjusting interest rates, by buying or selling government bonds, by changing the reserve requirements on commercial banks, and so on. We'll spend a full episode on this later in the series. Episode 5, Central Banks, the people who print the money. For now, hold on to just one thing. In 2020, when COVID hit, central banks around the world flooded the system with cash. Trillions of dollars, trillions of euros, trillions of yen, all to keep the economy from collapsing. And that money, almost exactly on schedule, led to the global inflation wave of 2021 and 2022. The connection between money supply and price level showed up with frightening clarity. The wage price spiral. Okay, so that's how inflation starts, but here's a different question. How does inflation keep going? Because there's a huge difference between prices rising once and prices rising and not stopping. This is where one of the most important concepts in macroeconomics comes in. The wage price spiral. Here's how it works. Prices go up, so workers do what anyone would do. They think, if prices have gone up and my paycheck hasn't, I've effectively gotten poorer. So they ask for a raise. And in a tight labor market, companies have to give in to some degree. They need the workers. But when wages go up, the company's production costs go up. So the company raises its prices, which means the general price level goes up. Again. Which means workers, once again, feel poor. So they ask for another raise, and the loop spins. This is the spiral. And once it starts spinning, it is terribly hard to stop. Prices push wages up. Wages push prices up. The whole thing feeds itself. This is why central banks are so paranoid about killing inflation early. Because once the spiral really starts turning, the only way to stop it is by imposing a much higher cost, usually in the form of a recession. The Fed has to raise rates so hard that the economy contracts, demand collapses, workers get laid off, and the wage pressure finally breaks. That's the trade-off. Catch it early at a small cost, let it run, and the eventual bill is much, much bigger. How we measure inflation. One last thing to cover. How is this rising general price level, actually measured? The most important tool is the Consumer Price Index, the CPI. In the U.S., it's calculated by the Bureau of Labor Statistics, or BLS, every month. The BLS sends data collectors to thousands of stores across the country, recording the prices of roughly 80,000 different items. Those prices are then weighted according to actual consumer spending patterns and rolled up into a single index number. The categories cover everything you can think of: food, housing, transportation, healthcare, education, clothing, recreation, the whole basket of what an average American household buys in a month. U.S. CPI is released on a specific schedule, usually the second Tuesday or Wednesday of the month at 8:30 a.m. Eastern Time. That release moment is one of the most watched events in global finance. Within 60 seconds of the number hitting the wire, stocks, bonds, and the dollar all move, sometimes violently. Hedge funds run entire trading strategies built around that single 8:30 a.m. release. That's how much weight this monthly number carries. But CPI is not a perfect measurement. There are real debates about what should be in the basket, how items should be weighted, how it handles things like quality improvements when you pay the same price but get a better product. There's often a meaningful gap between the official inflation number and what people feel in their daily lives. The deepest of those debates, headline inflation versus core inflation, we'll get into next. Headline versus core. If you read any serious macroeconomic commentary, you'll see two terms thrown around constantly: headline inflation and core inflation. Knowing the difference between them lets you read inflation news at a completely different level. Headline inflation is the full CPI, every item included: food, energy, the works. It's the number closest to what you actually feel when you go shopping. Core inflation is headline inflation minus food and energy. Why strip those out? Because food and energy prices are extremely volatile. Crop yields swing with the weather. Oil prices swing with geopolitics. Both can spike or crash in a way that doesn't reflect any deeper trend in the economy. The academic and policy consensus, going back decades, is that monetary policy shouldn't react to that short-term noise. So policymakers focus on core, the underlying signal with the noise filtered out. That's the real target of monetary policy, core. Now here's a twist that most people don't know. The Federal Reserve doesn't actually target core CPI. It targets a different measure entirely, core PCE. PCE stands for Personal Consumption Expenditures. It's published by the Bureau of Economic Analysis, a different government agency. While CPI is built from household surveys, what people say they buy, PCE is built from actual business sales data, what people actually bought. The Fed adopted PCE as its preferred measure back in 2000 on the reasoning that PCE captures substitution behavior better. When something gets too expensive, consumers switch to alternatives. PCE picks that up. CPI is slower to adjust. So when you hear Fed officials talk about their 2% inflation target, they are specifically talking about core PCE, not CPI, not headline, core PCE. Different central banks use different yardsticks, by the way. The Bank of England targets CPI directly. The European Central Bank uses something called HICP, the Harmonized Index of Consumer Prices. Different agencies, different methodologies, but the same underlying job. Market participants watch both headline and core. Short-term market reactions are driven by headline because that's what shocks people. Long-term policy paths are determined by core because that's what the Fed is actually watching. When the two move together, the market direction is fairly clear. But when they diverge, when headline comes down but core stays sticky, that's when things get messy. 2023 and 2024 were exactly that situation in the U.S. Headline inflation came down relatively quickly. But core services inflation refused to drop below 4% for most of 2023, which is why the Fed kept rates high for so long. Why they kept saying, we need to see more data. So the takeaway is simple. The next time you see an inflation headline, ask yourself one more question. Which inflation are we talking about? Headline or core? CPI or PCE? Goods or services? That one extra question is the first real step toward reading macro deeply. Conclusion, the quiet thief. So today we walked through inflation from end to end. What it is, where it comes from, how it keeps going, how we measure it, and how even the word inflation hides several different ideas underneath it. I want to close on a line from Milton Friedman that captures all of this in a single sentence. Inflation is taxation without legislation. Think about what that actually means. When prices rise, the money you already have becomes worth less. That value doesn't disappear into thin air. It transfers quietly away from you. Without a vote, without a notice. You just walk into the store one day and your wallet is lighter than it used to be. That's the real face of inflation. Which leads naturally to the next question. How do you control this thing? How do you bring it back down? The answer, in one word, is this: interest rates. That's the topic of the next episode. What is interest? The price of money. We'll start from the interest you earn on your savings account, work our way out to market rates, and end at one of the most important concepts in all of finance. The discount rate, the rate that secretly determines the price of every asset on the planet. I'll see you in the next one. Wall Street Wires Foundations, hit subscribe and turn on notifications so you don't miss new episodes as they go up.